to shelter your business profits from tax? Hey everyone, Adam Bergman here, tax attorney, founder of IRA Financial. Welcome to another episode of Adam Talks. On today's episode, two strategies where you can shelter profits from your business or a business you are involved in tax-free. And guess what? It has to do with a Roth IRA. Surprised? Probably not, right? Because that's what I do. I find ways to use your retirement funds to generate tax advantageous solutions for you, for your investments, and ultimately for your business. So there are two scenarios. The first covers a situation where you'll own less than 50% of the business. And the second scenario is where you're going to own more than 50% of the business and be involved. So the first scenario involves a Roth IRA and essentially follows the Peter Thiel model. And the Peter Thiel model is pretty simple. There's two factors to consider. Number one, before I do that, who's Peter Thiel? Well, he's a billionaire that was probably the smartest Roth IRA investor. He is reportedly has a $1 billion plus Roth IRA. And actually, someone I know helped him set up his first Roth IRA and kind of educated him in the late 90s about the power of the Roth IRA. Someone that I used to compete with, someone who's, very smart, great man, and kind of helped him along this way. So Peter Thiel founded PayPal. He was one of the first investors in Facebook, and he's used this Roth IRA to make both those investments along with other very successful businesses, investments into Palantir and other types of companies. But what he did essentially is he took his Roth IRA, invested it into a startup that had very, very low value, like 0.0001 cent a share. Why? It was a startup. It had no intrinsic value, no accounts, no inventory, nothing, no goodwill, just a shell of a company with an idea. And he paid fair value, the same value as any other investor would at that time, or any other founder. And on top of that, what characteristic was relevant to his situation is he owned less than 50% of that business. Okay, so PayPal was much less. So he used like $2,500 in a Roth IRA, literally, to buy millions of shares of PayPal, which turned into about $27 million or so tax-free. And then when he made his first investment in Facebook for just $500,000, he used a Roth IRA. Clearly, he was going to own a very small percentage of it. And he turned that into like 300 and something million tax-free. And then he was off to the races. So the first model is you're investing in a startup. Maybe you're going to have some involvement. You can be on the board, an executive, an employee. You're going to own less than 50%. You're going to have to pay the same value as everyone else at that point. Okay, so if you're coming in at an early stage with other founders, you'd pay a penny a share, $1 a share, whatever the value is, so long as everyone pays the same amount, and you need to stay under 50%. Why? Because the prohibited transaction rules under 4975 do not allow your IRA to invest in a business where you personally will own more than 50% in conjunction with all other lineal descendants, so parents, children, spouse, daughter-in-law, son-in-law. So there's attribution, meaning if you own 30%, your wife owns 30%, now you're at 60, and now your IRA can invest in that type of Peter Thiel scenario. So you got to be under 50% along with all disqualified people, lineal descendants, or entities you control. So typical situation, me and 4 people are starting a company. We're going to own 20% each. I'm going to take half of that 20%, 10%, put in a Roth, the rest put it personal funds. I'm going to pay the same amount, $1 a share for my shares. So I invest whatever, $2,000, $20,000, whatever the buy-in is, and I split it between my Roth and me personally. Now, what's the value of the Roth? And I probably should have started with this, is so long as you're over 59 and a half and the Roth's been open at least 5 years, everything you pull out is tax-free. Okay, no ordinary income tax, no capital gains tax, nothing, tax-free. So that's obviously super tax advantageous, right? Not all startups work. Clearly, there's a high failure rate. So that's something you got to understand. If you put $5 grand or 10 grand in your Roth IRA, there's a chance you lose it, right? But if you do hit a home run, your business goes really well, then you can shelter the income from tax. So let's stay on that first Peter Thiel model. It works best in a corporation. Why? Because if your Roth IRA invested in an LLC, okay, let's say it's 5 partners, 20% each, and you're going to be the CTO or CFO, and that's fine. You can do it. You're under 50%. However, if the business generates more than $1,000 of business income, there's a tax known as UBIT, unrelated business income tax, that would apply and implicate a 37% tax on business income allocated to the IRA in excess of 15 or so thousand bucks. So you're getting the Roth benefit, meaning the money after that tax will go to the Roth tax-free, but still, you're still paying pretty hefty 37% tax. Now, if you set up a C Corp, you can reduce that UBIT tax to 21%. Okay, so if you invest in PayPal startup or XYZ startup, and you set up a C Corp, let's say the C Corp makes $100, it's going to pay $21 to the federal government. Depending on the state, there may be a small state tax. And then whatever's left over could be sent as a tax-free dividend back to the Roth IRA. So you only have one layer of tax at a low rate, 21%, versus the UBIT tax rate of 37%. And now the money's in the IRA, and then you can reinvest it, do some other deals, buy stocks, real estate, cryptos, gold, whatever you want. But what you're doing is sheltering all the profits, right? Because $100, you pay Uncle Sam $21, you're left with $79. Instead of paying tax on that going forward and reinvesting it, you can dump it into the Roth IRA as the owner by way of a dividend, tax-free, and then the Roth IRA can invest it, and that money is now sheltered from tax going forward. Once you're 59 and a half, the Roth's been open more than 5 years, it's all tax-free. So that's the Peter Thiel model. It works if you're going to own less than 50%. What happens if you want to own more than 50%? That model is not going to work because you're going to trigger the prohibited transaction rules under Internal Revenue Code section 4975, and it's not going to happen for you. So the second model is known as ROBS, Rollover Business Startup Solution. It takes advantage of an exception in the tax code under 4975 D13 that allows a 401k to buy, a 401k to buy stock in the adopting employer. So it allows a 401k to buy corporate stock. So just like if you worked at McDonald's, you'd be able to use your 401k to buy stock in the McDonald's Corporation. Same strategy. You set up NewCo. NewCo is going to be an exciting new AI technology company. You put $100,000 rollover into your new 401k plan, which is adopted by NewCo. The 401k takes the 100 grand, contributes it to the company in return for stock. So the 401k, let's say, owns 80%, 90% of the company. And the company then takes that money, buys computers, equipment, servers, whatever, chips, whatever it's going to do. And then any profits, the corporation pays 21%. And then whatever's left, you can dividend back tax-free to the Roth 401k. And then the Roth 401k can continue to grow as those investments will be sheltered from tax. What the ROBS does is it lets you, number one, get involved, use your retirement money in a business you'll control, own more than 50%. You can earn a salary from that business where you're going to control it. So the 4975D are the exceptions to the prohibited transaction rules under 4975C. So you're probably saying, well, that sounds too good to be true. How is that possible? Well, there's a specific exemption under 4975D13 that allows this to occur. Whereas in the first Peter Thiel model, there's no exception. So you got to be under the 50%. Make sure, of course, you're paying fair value for the stock. This was all examined in 2014 by the IRS, or I should say the Government Accountability Office report. And they looked at this issue. It was really the Peter Thiel model. And they basically concluded as follows. We can't really attack it. If fair value is being paid, they're going to own less than 50%. There's a 3-year statute of limitation, which doesn't give us a lot of time to figure this out, because generally the gains from these companies doesn't happen for at least 3, 4, 5, 10 years, right? These companies that mature and eventually gain in value. So by the time they realize what's going on, the statute of limitation ran, meaning they can't attack the transaction anymore. So when you add all that together, the IRS is basically throwing their hands up saying, hey, we're not sure what we can do. Number one, it's legal. Number two, even if we have issues with it, we're going to run out of time because of the statute of limitation. So the Peter Thiel model works great. It's cheap to do with a Roth IRA. It's easy to set up. You don't need a lot of money if it's a startup, but you got to be under the 50% threshold. And it works best when the company is literally off the ground, like just started up, because you can buy the shares for pennies. Much harder when it's a more mature company, because you're going to need more money in a Roth, clearly, because there'll be value, intrinsic value to that business. If you need to own more than 50%, it's just the way it's going to be. You don't really have a lot of good partners, and you kind of got to go in on your own. That's cool. The Thiel model is not going to work, so you're going to have to do the ROBs, meaning you're going to have to set up a corp, and which is okay because we'll block the U-bit, but you're also going to have to set up a 401k, Roth 401k versus a Roth IRA, which is not an issue, right? The only difference is if you have employees, you'll have to offer your employees 401k benefits, which I personally think is a good thing. And there's higher administration costs, about $1,500 a year versus a Roth IRA. It's like $400 or $500. So it's a little bit higher cost, but you can earn a salary and own more than 50% of that business with a Roth, which for some entrepreneurs is super, super exciting. Because again, yes, you do have to pay the 21% corporate tax. I can't get you around that, but all the retained earnings, everything after the tax has been paid, can be sheltered into a Roth 401k or IRA tax-free, and then you can reinvest those funds into different investments in the Roth and never pay tax. So it's really an unbelievable tax strategy. It's just really best employed when you do it in the beginning. It's much harder. It's going to be more costly if you do it after the company's worth $1 million or $10 million, because you're going to need to have enough money in your Roth, or at least convert enough money to Roth to be able to buy those shares, which most of us can't do. So this is much easier to do at a startup. It's obviously low risk because, again, if you're only putting in $5,000, the most you can lose is $5,000, right? And if you do get caught on an IRS prohibited transaction, the most they're going to catch you and get you is for that $5,000, because that's the amount that was invested. It's not the fair value on the time to catch you. They got 3 years. It's the value when the investment was made. So super low risk. The upside is enormous. You can shelter all the profits. And again, a lot of smart people are doing this. It's not just Peter Thiel's. He's the most famous. Lots. I've helped thousands of people do this. There should be millions, honestly. Any entrepreneur should be at least putting some of their business stock into a Roth IRA. Just need to remember the two models. If you're under 50%, you can do the Roth IRA. If you're over 50%, you do the ROBs. It's kind of all you need to know. We handle all the rest. We'll take care of all the administration, the IRA or the 401k, do the setup, do everything. So it's something to consider. I can promise you most people, when they hear about this, are generally like, oh my God, I wish I did this when I was setting up my business. So hopefully now you're listening or watching this on YouTube and you're like, oh my God, I get it. Hey, I'm thinking about starting a business, or if I do start a business down the road, think Roth. It may not work for you, and that's cool, but at least consider it, because you could potentially shelter all your profits from tax, which when you're going to sell your business in the future, you'll thank me, I promise. So that's my thing. Just wanted to kind of talk about this. I've done some blogs, and I'm pretty sure I've done some videos and podcasts on similar topics, but I wanted to break it down with the under 50% Thiel model Roth IRA, over 50% ROBs model, because I think there's some confusion as to what model works best for what person, and it's really the ownership level is what is the determining factor, because once you're over the 50%, the IRA is not going to work just under the prohibited transaction rules, although the exception for the ROBs under 4975D13 will let you engage in this type of transaction just with a 401k and a corp versus an IRA, a Roth IRA and a corp. So that's it for today. I hope you guys enjoyed today's podcast. Hope you learned something. Just again, it's all about issue spotting. It may not be interesting to you today, but hopefully it'll resonate and you'll remember it and go back in a year, 2 years, 3 years. Be like, I remember when that guy said about sheltering profits from Roth. Let me go find his podcast or go search it on YouTube, because all these podcasts are available on YouTube. And then you can rewatch the video, and hopefully you'll pick up a few things. And if I can save you tax, that's what I love to do. It's all about using the tax code to our advantage. It's there. You just got to know the rules. I'm not talking about doing anything that's not permitted under the code. Just knowledge is power, and most people don't understand the rules, especially involving retirement funds and taxation. And that's been my passion, is to help democratize this and explain and teach everyone that these rules aren't that complicated. The retirement system is literally rigged in our favor. Democrats, Republicans, whatever the case may be, they've actually built a really, really good system that helps all of us. The problem is most of us don't know how to use it and don't understand the rules. But once you understand how the rules work, wow, you can really do some magical things and really shelter a lot of gains and income from tax. So there you go. Hope you enjoyed today's podcast. And that's it. Take care. Have a great day. And I'll see everyone again next week. Ciao.